Okay, now let's start with the cash and accrual basis, and we will have single entry. Actually, chapters 14 and 15 go together. Now, today, since we have no class, it's a holiday, and tomorrow will be another no class, so I will just keep on recording so we can finish our subject matter. So we have now cash and accrual basis for the methods of accounting. Cash basis, income is recognized when received regardless of when earned, and expense is recognized when paid regardless of when incurred. So in other words, what's important in cash basis of accounting is when cash was received and when was it paid. Now, in other words, this approach does not recognize accounts receivable, accounts payable, accrued income, deferred income, accrued expense, and prepaid expense. Now, on the other hand, accrual basis for income is recognized when earned, regardless of when received, and expense is recognized when incurred, regardless of when paid. So, in other words, we have for the essence of the accrual basis is the recognition of accounts receivable, accounts payable, accrued income, deferred income, accrued expense, and prepaid expense. Now we have the cash basis versus the accrual basis. So for sales, under the cash basis, we have to include cash sales plus collections of trade receivables. Now that is for the amount of sales. Now, under the accrual basis, sales will be equal to cash sales plus sales on account. Now, for purchases, under the cash basis, we have cash purchases plus payments to trade creditors. So that will include your accounts payable and your trade notes payable. Now, under the accrual basis, cash purchases plus purchases on account. That's the amount for purchases. Now, income other than sales, for cash basis, items received are considered as income regardless of when earned. Items earned are considered as income regardless of when received. Now, that is under for your income other than sales, like your rent income or interest income. So what's important is we have under the cash basis of accounting, we have to include for income other than sales items received. So in other words, under the cash basis of accounting, what's important is the receipt or the payment. Now, for expenses in general, under the cash basis, we have to include items paid are treated as expenses regardless of when incurred. Under the accrual basis, items incurred are treated as expense regardless of when received. Now, for depreciation, we have to include under the cash basis. Depreciation is provided normally just like under the accrual basis. Now for bad debts, under the cash basis, no bad debts are recorded because trade receivables are not recognized. So under the accrual basis, record doubtful accounts as bad debts. Now we have the computation of sales. So for sales, we have the cash sales. Then we add the sales on account, trade and notes receivable, and then we add collectible or collection of trade accounts and notes receivable, sales returns, allowances and discounts, accounts and notes receivable written off, trade notes receivable discounted. So notes receivable is directly credited. From the total, we deduct trade accounts and notes receivable beginning. Then we now get your sales on account. Adding it to the cash sales, we have the total sales under the accrual basis. Now for normally, the data concerning the sales and the collections from customers are given. So the main problem, the formula is computation of sales on account. The substance of the formula is the reconstruction of the accounts and notes receivable, because the total accounts and notes receivable would represent the total sales on account. Thus, the approach is to add back all the items that decrease trade receivables to the ending balance of accounts receivable and notes receivable. The items that decrease receivables normally include collections from customers, sales returns, allowances and discounts, accounts and notes receivable written off, notes receivable discounted when the notes receivable account is credited upon discounting. The beginning balances of accounts and notes receivable are deducted because these items pertain to the preceding year and constitute sales of the prior year, and that they might have been collected during the current year, or some may be the subject of returns, allowances, and discounts. And by the way, notes receivable here would only refer to trade notes receivable. You might have other notes receivable which are non-trade. We do not include it in these computations. Now we have next the computation of purchases. We have purchases on cash. Then we have purchase on account, trade accounts and notes payable, and again we are referring to trade notes. Payments of trade accounts and notes payable, purchase returns, discounts and allowances, and from the total we deduct trade accounts and notes payable beginning. The difference is your purchases on account that we add to cash purchases. So the total will be your total purchases on accrual basis. Now, income other than sales, income received on cash basis, then we add deferred income beginning, accrued income ending. So just try to take note that deferred income, we are referring to income pre-collected or collected in advance. It's the reverse of accrued income. So that's why we add deferred income beginning and add accrued income ending. Then the total, we deduct deferred income ending and accrued income beginning. Now we have the income for the current year under the accrual basis. Now note that the formula involves deferred income and accrued income. Now for expenses, we have expenses paid or the amount to be reported under the cash basis. Then we add prepaid expense beginning, then add accrued expense ending. From the total, we deduct prepaid expense ending and accrued expense beginning, the difference is expenses under the accrual basis. So take note that we have prepaid expense and accrued expense with reverse treatments. Note that the formula involves prepaid expense and accrued expense. Okay, so that's all for cash and accrual basis. Then we continue, actually single entry is already part of chapter 15 and they used to go together. So the characteristics of single entry. The very heart of the accounting process is the analysis of the dual effect of each transaction on the basic accounting model. Assets equals liabilities plus capital. All transactions are normally analyzed and recorded in terms of debits and credits. This system is called the double entry system of bookkeeping. So when you have a debit and credit, now we call it double entry. When you record transactions in terms of debits and credits, we have the double entry system. A system of record keeping in which transactions are not analyzed and recorded in the double entry framework is called a single entry system. Where the records are incomplete, they are said to be maintained on single entry basis. Under the single entry system, the records maintained are represented only by the so-called bare elements or bare essentials. Normally, the records include a record of cash, accounts receivable, accounts payable, property, plant, and equipment, and taxes paid. The major record under the single entry system is the cash book. The cash book is maintained showing all receipts and disbursements. And because in a single entry, no specific accounts for the receipts and disbursements are debited or credited, only a description thereof is made. With respect to accounts receivable and accounts payable, only a list of customers and creditors is made with their corresponding balances. Now, the computation procedure followed is in determining net income or loss is simply to compare the capital or retained earnings at the beginning of the year and capital or retained earnings at the end of the same year after taking into consideration withdrawals or dividends and additional investments. The difference is either net income or net loss. Any increase in capital or retained earnings is net income, and any decrease in capital or retained earnings is net loss. The single entry method of determining net income or loss is known as the net assets approach, or we have the capital maintenance approach. So the formula for proprietorship or partnership, we have the capital at the end of the year, then we add withdrawal total, we deduct the capital at the beginning of the year, and additional investments, we have the net income or loss. But for the corporation, we have now retained earnings. At the end, we add dividends declared or paid and other items that decrease retained earnings but not profit or loss. So from the total, we deduct retained earnings beginning other items that increase retained earnings but not profit or loss. So we have the net income or loss. The preparation of financial statements. The preparation of the income statement involves the computation of individual revenue and expense balances by reference to the cash receipts and disbursements and the changes in assets and liabilities. The formula used in converting cash basis to accrual basis of the accounting are useful in this case. Formula involve the computation of sales, purchases, income other than sales, and expenses in general. The preparation of the statement of financial position involves inventorying, counting, and verification procedures to determine the nature and amount of most of the assets and liabilities. Okay, so this is enough for but anyway, may I refer you to read the book the for more information. Now let's go to the problems. We will take up the problems of chapter 14 and then move on to the problems of chapter 14. Now I'm going to begin with the straight problem. So we refer now to problem 14-29. Okay, now let's start with the 14-29. I'm starting with the straight problem and then we go back to the multiple choice. Now the requirements of 1429, number 1, prepare adjusting entries on December 31, 2020. Prepare an income statement for the year ended and statement of financial position. Now for the entries on December 31, 2020. Now this includes your entries for at the same time closing entries. So we have entry number 1 in order to close your amount of December 31, 2019 accounts receivable. So we now debit to sales and credit to retained earnings. Now that's for 2019. Then for 2020, we debit to accounts receivable 250,000 and credit back to sales. So we have now your as stated, the company began operations only on January 1, 2019. During the year ended December 31, 2020, the accounting records have been maintained on a double entry basis, but the cash basis of accounting has been employed. The trial balance prepared from these records on December 31, 2020 appeared as follows. So in the PowerPoint presentation, it was mentioned that under the cash basis of accounting, sales will only be the sum of cash sales and collections of accounts receivable. So you will notice that in the trial balance given, you cannot find accounts receivable nor accounts payable. So we have now to prepare the corresponding adjusting entries where in number 1 we have to record debit sales, credit to retained earnings. That's for accounts receivable beginning. Then second, we debit to accounts receivable for 250,000 and we have to credit sales. Now in number 2, we debit to retained earnings for 40,000 and as we credit to sales. Now as stated, the sales of 2019 included 40,000 deposited by a customer for merchandise to be delivered in 2020. So actually, the 40,000 is an actual sales of 2020. However, this was recorded in 2019. So it was already recognized as income and finally close to retained earnings. That's why we are going to debit retained earnings as this was an actual sales only in 2020. So for the next adjusting entries, we now debit to retained earnings and credit to purchases. For accounts payable, we have now accounts payable beginning of 350,000 and credit to purchases pertaining to last year. Then this year, we debit to purchases and credit to accounts payable for 280,000. Then next, we have accrued expenses for the amount of 70,000. We now debit to retained earnings and credit to expenses for the 2019 accrued expenses. Now, in other words, in 2019, this amount was not recorded, so the retained earnings was overstated because of the overstatement in net income. The fact that the amount of expenses of 70,000 was not recorded in 2019, so it overstated net income and also retained earnings. That's why in 2020, we have to debit back retained earnings and credit to expenses. Now, why do we credit expenses? The fact that this amount is already accrued in 2019 and under the cash basis of accounting, we only record expenses when actually paid. Now, the 70,000 was actually paid only in 2020. So, we have to credit back expenses. This was an expense in 2019 and not in 2020. So, debit to retained earnings and credit to expenses. Now, for the current year's accrued expense, we debit to expenses and credit accrued expenses. for 100,000. Next, we have merchandise inventory 2019. That's beginning of the year 2020. We debit to merchandise inventory and credit to retained earnings. Now, since this amount was not recorded at the end of 2019, so it will be recorded at the beginning of January. This is a beginning inventory. Then we have to record inventory at the end of the year by a debit to merchandise inventory at the end of the year and credit to income summary. So actually one is for the beginning and the other one is for the ending. Then number 6, the purchases included 100,000 cash advance to a supplier for merchandise to be delivered in 2021. So the company paid to a supplier. Actually, there was no purchase yet, but only that an advance was made. So we debit to advances to suppliers for 100,000 and credit to purchases. Now it will be recorded. The purchases will be recorded next year. The equipment was acquired on July 1, 2019. The estimated life is 20 years. So we now debit 2. Every year we have since the equipment in the trial balance has a balance of 200,000. So divide it by 10 years. Every year depreciation is 20,000. It was acquired only on July 1, 2019. So July 1 up to December 31. It's only good for 6 months. And we have 1 year for 2020. Now we debit to depreciation of equipment for 2020. Debit to retained earnings as this is an adjustment to prior years records and credit accumulated depreciation by 30,000. The land and building were acquired on January 1, 2019. The life of the building is 5 years. So we have now the land and of 800,000, the building of 1.5 million. We divide by 5 years. So annually depreciation on the building is 300,000. So for last year, we now debit to depreciation of the building. This year, we only have 300,000 for this year. And we have to recognize depreciation, or we have the amount of 300,000. Actually, depreciation on the building is only for this year. So please correct the entry. Debit to depreciation building 300,000. That's for the year 2020. And another debit to retained earnings. That's a debit and not a credit. So debit retained earnings for 300,000. That's for 2019 nga depreciation expense. And credit accumulated depreciation on the building 600,000. Repeat, entry number 8, debit depreciation on the building 300,000, debit to retained earnings 300,000, and credit accumulated depreciation of the building for 600,000. Okay, so please make correction to the entry in number 8. Number 9, it's estimated that 10% of the outstanding accounts receivable on December 31, 2020 may prove uncollectible. So number 9, debit to doubtful accounts and credit to allowance for doubtful accounts. Now it's the rate of 10%. multiplied by the accounts receivable balance at December 31, 2020, given in additional information. Number one, it's 250,000. So we multiply 250,000 by the rate of 10%. So we now debit to doubtful accounts or bad debts for 25,000 and credit to allowance for doubtful accounts. Now this is your adjusting entry. Then number 10, the mortgage was on the land and building and was obtained on September 2020. The interest rate is 12% per annum, payable semi-annually on September 1 and March 1. The mortgage will mature after 4 years. So we have now the entry debit to interest expense. The amount of the mortgage given the problem is 900,000. And then we multiply this by the rate of 12%. That's good for 1 year. And we have, since it was taken only in September 1, 2020, counting September up to December is 4 months. So that will be 4 over 12 debit to interest expense and credit accrued interest payable for 36,000. Now we are done with the adjusting entries. We will prepare the income statement and the statement of financial position. So for the second requirement of the problem, an income statement for the year ended December 31, 2020, we now debit to sales. The amount of sales given the problem is 4 million, and now we are recording 4,090,000 because in our adjusting entry number 1, okay, we debit to sales and credit retained earnings. Likewise, we have a credit to sales and number 2 entry, credit to sales. So if the amount of sales initially given was 4 million, and we are going to debit 200,000 and credit 40,000 and credit 250. So in other words, we got two additions. That's for a total of 250,000 credit sales for 40,000. So 4,290,000, and we debit those sales for 200,000. So that's why we have 4,090,000. That is the adjusted amount of sales in the income statement. Then for cost of goods sold, we begin with merchandise inventory on January 1 or December 31, 2019. The amount of 150,000. The ending is 210,000. Now we have the amount of purchases given the problem is an initial amount of purchases given at 2 million. Then we have to reflect the adjustments made to the purchases account. So in entry number 3, we credit purchases, and still we debit purchases. So we add, kay ang purchase normally debit, we add 280. So you now get the total of 2,280,000, and we have to deduct the amount of 350,000. Okay, so but we have another adjusting entry crediting purchases for 100,000. So we have now the total credit to purchases is 450,000. The difference of 1,830,000. 1,830,000. Okay, I'll repeat. Purchases in the trial balance is given at 2 million. And then in the adjusting entry, debit 280,000. And we got two credits for 350,000 and 100,000. So the total of your adjustments to purchases is now equal to 1,830,000. So the total goods available for sale, 1,980,000. We deduct inventory end of 210,000. Given the problem, so the cost of goods sold is 1,770,000, giving us the gross income. And among the expenses, we have expenses in general. The beginning balance of expenses initially was 1,500,000. Okay, 1,500,000. And we have to reflect the following adjustments. Now we have entry in number 4. We credit expenses for 70,000 and we debit for 100,000. So that will be an addition. Okay? Then we have a credit for the amount of 70,000. Now the other elements should be segregated like depreciation. Okay, so we have now the amount of expenses of 1,600,000 minus 70,000. Then you have the amount of expenses of 1,530,000. So repeat expenses 1,500,000 given in the trial balance. Then we add 100,000 from the adjusting entries. So 100,000 is an addition. It's a debit in entry number 4. We now debit 100,000 and we have a credit by 70,000. So our net expenses of 1,530,000. We have depreciation of equipment 20,000, building 300,000. Then we have doubtful accounts from the entries above for 30,000 and credit to we have doubtful accounts given at 25,000. That's entry number 9. And we have to debit interest expense. That's now on entry number 10. We have to record interest expense and credit to accrued interest payable. So the total of the expenses, and that gives us the difference as net income. So we are done with requirement number 2. We go to requirement number 3 is statement of financial position. So for cash given in the trial balance 1,500,000. Then accounts receivable, net of allowance, accounts receivable end of 280, accounts receivable at the end of the period, no, is 250. Then we deduct the allowance of 25. The carrying amount of the accounts receivable is 225,000. Then advances to supplier being a current asset and merchandise inventory at the end of the period is equal to how much? A merchandise. We have now your merchandise inventory at the end of the period of 210,000. So the total current assets 2,035,000. Land given and trial balance 800,000. Then building we deduct 2 years accumulated depreciation of 600,000. So we have the carrying value of 900,000. Furniture and equipment 200,000. Deduct accumulated depreciation for 1.5 years of 30,000. The difference of 170,000. So we have the total assets of 3,905,000. For the current liabilities, you have accounts payable of 280,000. That's your accounts payable at the end of the period. Accrued expenses of 100,000 at the end of 2020. Accrued interest payable of 36,000 in entry number 10. Okay, so these are now your liabilities. Total current liabilities 416,000. Non-current liability mortgage payable of 900,000 given in the trial balance, and we have retained earnings and share capital given is 2 million and retained earnings now with a balance of 589,000. Total liabilities and equity of 3,905,000. Now, how was the retained earnings computed? Retained earnings, January 1, retained earnings. We are given in the problem the retained earnings of 600,000. However, we have the adjustments. So, how was the amount of 180,000 taken? Your retained earnings beginning balance before adjustment is 600,000. Let's look at the adjusting entries affecting retained earnings. So we have credit to retained earnings for entry number 1, we credit for 200,000. Then a debit for 40,000 in entry number 2. That's debit to retained earnings and credit sales. Then another debit to retained earnings for 350,000 for your accounts payable beginning. Then number 4, debit to retained earnings for 70,000 for the accrued uh, expenses beginning. Then we have now credit to retained earnings for 150,000. That's entry in number 5 for 150,000. And then number 7, debit to retained earnings for 10,000. Okay, debit to retained earnings. Then another credit to retained earnings for 300,000. That's in entry number 8. Credit to retained earnings for 300,000. And okay, so these are the adjustments. Retained earnings with the following additions: 200,000, 150,000, and 300,000. The total 1,250,000. Adding 600 beginning balance plus 200, so that makes 800 plus 150 is 950 plus 300 equals 1,250,000. Okay, now for we have the deductions to retained earnings. First, we have the deductions, meaning the debits to retained earnings. So entry 40,000, another retained earnings of 350,000. That's a debit. Then we have another debit for 70,000 and a credit for 150,000. Then another debit to retained earnings for 300,000. The one with the correction. The one with correction. Sa entry number 8, debit depreciation building 300,000, debit retained earnings 300,000, and credit accumulated depreciation. So if the total of the credits retained earnings is 1,250,000 and the total of the debits is 570, 870. So you get 390 plus 70 is 460, 470. That makes a total of 870, 9, 10, 17, 770. So what is the remainder of your retained earnings? Okay, so take note that to retained earnings, we have the debits of 40 plus 350, 390 plus 70, 460 plus 10, 470 plus 300, 770. So how much is the balance of retained earnings in our computations? Retained earnings adjusted balance on January 1 is 180,000, and we add net income of 409,000, so that makes 589,000. Total of 2,589,000. Then we add liabilities of 1,360,000, and the total of 3,905,000 for your total liabilities and stockholders equity. Okay, now we go to problem 30. We have now 14-30. The requirements are adjusting entries on December 31, 2020, an income statement and statement of financial position. So for the company's name is Evelyn Company. So 14-30, let's start with inventory, no? Evelyn Company recorded transactions on cash basis but prepared adjustments at the end of accounting period to conform with accrual basis. The entity provided the following account balances for the year ended December 31, 2020. So we have cash, accounts receivable, inventory, land building, accumulated depreciation, equipment, accumulated depreciation, accounts payable, share capital, retained earnings, sales, purchases, office expenses, rent, insurance, supplies expense. Now, these are the account balances for the year ended December 31, 2020. Now, for the additional information, inventory on December 31, 2020 is 230,000. Then our entry will be to debit inventory and to credit income summary. So we have no inventory data, but here for December 31, 2020 balance of 150,000 supposed to be at the beginning of the period, but the ending is already 230,000. So number 2 and 3 is to debit accounts receivable, and for 290 the beginning is 250, so there's a difference of 40 that you debit to accounts receivable and credit to sales. So you now have the effect of increasing the accounts receivable by 40,000. Now, it's estimated, by the way, if you compare this with problem 14-29, there you prepared 2 and 3. One is to debit accounts receivable, that's for your ending accounts receivable, debit accounts receivable, credit sales. And the first entry was to debit sales and to credit retained earnings. However, sales is debited and credited, so there's a difference of 40,000. Now here, second entry will be to debit doubtful accounts for 15,000. It's estimated that 15,000 of the outstanding accounts receivable may prove uncollectible, so we have credit to allowance. Then number 4, depreciation rate, building 5%, equipment 10%. So the building cost is 1 million, we multiply by 5%. So it's accumulated depreciation credit of 50,000. The equipment depreciation rate is 10%. So 400,000 times 10% is 40,000. Then in number 5, accounts payable, and we have beginning. So we have debit to purchases and to credit accounts payable. If we relate this to uh, 14-29, actually, you'll have two entries in 14-29. The first entry is to record your accounts payable beginning of 350. So, nag-debit siya retained earnings kang mag-credit purchases. Second entry is to debit purchases and to credit accounts payable. So, in this case, if you compare, now you only got the net amount. In number 6, accrued rent on December 31, 2019 was recorded the amount of 5,000. So we now debit to retained earnings and credit rent expense. The fact that it was unrecorded at year end of 2019. Accrued rent amounted to 10,000. Debit rent credit, accrued rent payable. Prepaid insurance, we now debit to prepaid insurance and credit to insurance expense. December 31, 2019, the amount of 7,000. So in number 8, prepaid insurance on December 31, 2019 in the amount of 7,000 was not recognized. So here we are going to debit insurance and credit to retained earnings. In number 9, prepaid insurance on December 31, 2020 amounted to 12,000. So debit prepaid insurance and to credit insurance. Now for the adjusting entries, and then after we have now your income statement. So the given amount of sales in the problem is 2 million, and then we are going to reflect the increase. Sales, we now have here credit by 40,000. So all in all, we have the total sales of 2,040,000. Inventory beginning is given in the trial balance. Then we add purchases. The given amount is 1,200,000, but we have an additional debit to purchase of 30,000. So that makes it 1,230,000 given in data number 1, inventory end of 230,000. So the cost of goods sold of 1,150,000, and the difference is gross income or gross profit. Then we deduct expenses. We have now the office expenses given, there are no adjustments. Then we have rent of 245,000. We have now your rent. Okay, 245 because we have 240,000, and we have adjustment number 7. That's rent for 10,000. So that makes 240 plus 10 is 250. Okay, 250. No, you are debiting. And in number 6, we deduct 5. So 250 minus 5. That's why you have 245. For insurance, the amount given the book is 50,000. Then insurance number 8 is debit for 57, and number 12 is deducted. So 57 minus 12 is 245,000. That's the amount of insurance of 45. So we have insurance 50,000, and we are adding 50,000 adjustment. Number 8 is 7. So 57 minus 12 equals 45. Adjusted amount of insurance expense. Then supplies given is 140,000. There are no adjustments to this. Then doubtful accounts in the amount of 15,000, and depreciation of 90,000. Here we are given doubtful accounts. Okay, in number 3, 15,000. And we have insurance for the amount of here. Okay, 45, 140, and 5. So we have now the total and giving us net income of 100,000. For the statement of financial position, the current assets includes cash of 200,000, then accounts receivable. Initially, we have accounts receivable of 250 given the problem. Then we are adding entry number 2, 40. So that makes 250 plus 40 equals 290, and we deduct the allowance of 15. 275. The inventory of 230 is at the end of 2020. Then prepaid insurance 12,000 in adjusting entry number 9. Total of the current assets. And for the non-current assets, we have land in the amount of 300,000, building of 1 million minus accumulated depreciation of 30,000. So we have 320,000. And we are adding this to the building. Equipment of 400,000 given the problem, and we deduct the accumulated depreciation on the equipment equal to 80,000. Okay, that's your accumulated depreciation of 40,000. So your equipment initially 400,000, and we deduct the accumulated depreciation on the equipment for a total of 80,000. So total assets, and we have the liabilities for your accounts payable 130. The given amount of accounts payable is 100. Then we have an additional credit of 30. Accrued rent payable, credit 10. And share capital 1.5 million. Retained earnings 447,000. Retained earnings at the beginning of the period. Okay, retained earnings per book of 345,000. Then unrecorded accrued rent, deduct, okay, debit retained earnings, credit for the unrecorded prepaid insurance. Total, we deduct the corrected beginning balance. Then we add net income for 2020. You now have the difference for your retained earnings. The statement of financial position. So we have the corresponding notes. Okay, we have the answers to 14-32. 14-32 and 14-33. Okay, now let's go back to the multiple choice problems, beginning with 14-1. These are all multiple choice. 14-1 up to 14-28. Okay, these are all multiple choice problems. Before we proceed to chapter 15. Alright, you now begin with 14-1. Okay, 14 does. Alright, so what does the problem require in 14-1? Under the cost basis, what amount should be reported as sales for the current year? So we have now your cash basis. We understand that under the cash basis, your sales is the sum of your cash sales and collection of accounts receivable. So we have now your accounts receivable December 31, 2019 in the amount of 1 million, and then we add sales for 2020 under the accrual basis for 4,600,000, and we have advances from customers 2020 in the amount of 300,000 given. Okay, so ending 300,000. Then the total we deduct accounts receivable here 2020 in the amount of 1,300,000. Then we have the write-off equal to 50,000, and we have advances from customers of 2019 for 200,000. We have now the collection on cash basis for the sales revenue. So 14-1, the answer is B. Now we go to problem 14-2. Question is, if the entity desires to prepare a cash basis income statement, what amount should be reported as sales for the current year? So we now have your accounts receivable beginning of 400,000. Then we add credit sales of 3 million, total of 3.4 million. Then deduct accounts receivable end of 2020 in the amount of 485,000. So difference is collections of 2,915,000. Then add cash sales 200,000. So your answer, the amount of sales under the cash basis of accounting. Then we go to 14-3. What amount of revenue should be reported for the current year under the cash basis of accounting? So in 14-3, we begin with accounts receivable on January 1. January 1, customers owed 1 million. December 31, 750,000. So here we find the beginning and the ending balances. So accounts receivable beginning equal to 1 million given. Then we add credit sales 3 million. Total is 4 million. We deduct accounts receivable end of 750,000 given. Then we have the sales discount of 150,000. So we have 900,000 collections. So the cash sales equals 2 million minus 100,000. Difference of 1.9 million. That's your cash sales. So the total sales on cash basis of 5 million. Your cash sales actually is 2 million. However, we have returns and allowances equal to 100,000. So the answer to 14-3 is letter A. Then 14-4, under cash basis, what amount should be reported as sales? In number 4, accounts receivable in January 1 given is the amount of 1 million. So accounts receivable in January 1. Then we add sales on account for 3 million. So we get the total. Okay. Then we have collections. We deduct the cash sales net. Okay. So we have now your, in 14-4, the answer is what amount should be reported as sales. So we begin with accounts receivable in January 1, 1 million. Sales on account 3 million. Total, we have accounts receivable at the end of 1.7 million and accounts written off of 100,000 is deducted. Normally, your entry for accounts written off is to debit bad debts and to credit accounts receivable. Collection of accounts receivable, 2.2 million, and we have now your cash sales to be added. You have the total sales on cash basis. So we have letter A. Next, we have 14-5. In 14-5, the question is asking for the amount of insurance premium paid in the current year. So we have now charges to insurance expense during the year, including year-end adjustment of 25,000. So charges meaning total debit 625,000. And then we add prepaid insurance on December 31 of 175,000. That makes 800,000 minus 150,000. Now please make correction. 150,000 is deduct. That's prepaid insurance on January 1. So deduct. The answer is 650,000. Now we go to question number 6. What amount was paid for operating expenses? So we have operating expenses per book given is 3.2 million. Then we deduct depreciation equal to 1 million. It's not paid anyway. Then we have prepaid insurance and add. Prepaid insurance beginning, deduct. Then accrued salaries payable, deduct the ending balance and add the beginning balance. Now remember that accrued salaries, that's liability, while prepaid insurance is an asset. So the treatments of the two will be reversed. So in 14.6, the answer in 14.6 is 2,270,000. Next, 14.7, what total amount of cash was received from rental in the current year? 14.7, the rental income under the accrual basis is given at 600,000. Now remember, under the accrual basis. For the problem is asking for the total amount of cash received from rental, meaning the rental income under the cash basis. So 600,000 in 14-7, we are going to add unearned rental income on January 1 of here. Unearned rental income of December 31, we add 75,000, deduct the amount on January 1 of 50,000. So add 75, deduct 50. And then we have accrued rental income on January 1, we add, and the December 31 deduct. Now remember, unearned is pre-collected, while unearned normally is liability, while accrued rental income is an asset. So again, the treatment of these two items, if the ending of one is added, the other one is deducted. So the fact that they are reversed. So 14.7, the answer is 615,000. That's letter B as in boy. Next, we go to 14.8. In 14.8, What does the problem ask for? Under cost basis, what amount should be reported as purchases for the current year? So inventory on January 1 is given at 2,100,000. Then we add purchases under the accrual basis. Uh, Actually, this is a question mark. So it's a squeeze figure. Goods available for sale. Then we have the inventory on December 31 of 2.5 million. Again, it's given. So we have cost of goods sold of 5,300,000 given. So we work back 5,300,000, add 2,500,000, 7.8 million the goods available for sale, deduct inventory of 2,100,000. The difference is 5,700,000. That's the amount of purchases under the accrual basis. So we now have your accounts payable on January 1 given at 1,200,000. Then we add purchases which is under the accrual basis computed at 5.7 million, total of 6.9 million. Then we deduct accounts payable and 1,350,000. Your cash paid for purchases under the cash basis is 5,550,000. Okay, now we go to problem number 9. Problem number 9. In the proprietorship statement of financial position on March 31, prepared under cash basis, what amount should be reported as capital? So we now begin with the capital on February 1. Capital on February 1 is given at 200,000. That's the initial cash investment. Then we have the cash basis income from February and March. The amount of 500,000. So the total we deduct withdrawals during March given at 100,000. So we have the capital on March 31 for 600,000. Now in number 10, under accrual basis, what amount should be reported as sales in the income statement for the year ended December 31, 2020? So ang ginapangita diri is sales under the accrual basis. We have now the cash sales given supposed to be, no? The cash sales is 1,750,000 cash sales. Then we add accounts receivable end of 300,000, total 2,050,000. We deduct accounts receivable beginning of 500,000. We have the sales on accrual basis. So the answer is 1,550,000. Then we go to 14-11. Under accrual basis, what amount of income should be reported in the 2020 income statement? So we begin now with the amount of cash basis income of 6 million, then add accounts receivable and we have accounts payable beginning. Remember, accounts receivable is the reverse of accounts payable. So add accounts receivable and add accounts payable beginning. Then deduct accounts receivable beginning and accounts payable end. We have now the accrual basis income of 9.5 million in 14-11. In 14-12, under the accrual basis, what amount should be reported for cost of goods sold in 2020? Accounts payable at the end, then payments to suppliers, so payments of accounts payable. Total, we deduct the accounts payable beginning, we have now your purchases. So inventory beginning, then add purchases computed above, then deduct inventory end. That gives the difference as cost of goods sold in 14-12. Now we go to 14-13 with four questions. Number one, under accrual, what's the amount of gross sales? So accounts receivable end, then we add accounts written off, sales returns, cash receipts from customers, and we add sales discounts. From the total, we deduct accounts receivable beginning. The difference is gross sales, 8,950,000. Then in question number 2, under accrual, what's the amount of net sales? Supposed to be it's the amount of net sales in number 2. So we have the gross sales, then we are going to deduct sales returns and discounts. So the net sales is 8,200,000. Then in question number 3, under accrual, what's the amount of gross purchases? So under accrual, now what's the amount of gross purchases in number 3? Accounts payable at the end, then we have purchase returns, payment to trade creditors, then purchase discounts. From the total, we deduct accounts payable beginning. So difference is gross purchases. Okay, so we have now in question number 4, under accrual, what's the amount of net purchases? So we have now gross purchases, then we have deduct purchase returns and discounts. Now the difference is to be recognized, the amount of net purchases is 5,250,000. That's question number 4. Next, we go to 14 again with 2 questions. In 14 question number 1, under the accrual basis, what's the amount of gross sales for the current year? So accounts receivable and notes receivable end, we now consider notes receivable as trade notes. Collection of accounts receivable, we have sales discount, collections of notes receivable, we get the total, then deduct accounts receivable January 1 and notes receivable. We have now your sales account, and we deduct the given amount of cash sales the balance now is your gross sales for the current year. Number 2, under accrual basis, what's the amount of gross purchases for the current year? So your gross, accounts payable and notes payable, and we have now the bank loan. Actually, ang bank loan hindi ni siya trade note. So gani nga i-deduct kay ang ari diri nga notes payable trade lang in connection with purchases. So payments, accounts payable, then we have your purchase discounts, payments on notes payable, we have the total. Then deduct accounts payable beginning and notes payable beginning. We have purchase on account and cash purchases. The difference is gross purchases. Now, under the accrual basis in question number 2. 14-15, what amount should be reported as prepaid royalties? So, prepaid royalties beginning, then we add adjustments on December 31. Then we have prepaid royalties, December 31. So we now get the difference of, okay, prepaid royalties, December 31 of, okay, next, number 16. On December 31, 2020, what amount should be reported as prepaid expenses? So we have now prepaid insurance, 32,000 times, that's the annual premium. Then we multiply by 6/12. So you get 16,000. Then add prepaid rent and prepaid insurance. So we have now your total 16 plus 20 is 36,000. Now that's the total of the prepaid. Okay, so 14-16, the answer is 36,000. Next, number 17. What's the amount of prepaid insurance on March 31? So we have now the prepaid insurance on March 31. The prepaid portion, company paid on March 1. So meaning it's good for 36 months. So meaning up to 31 of March. The portion that was actually considered to be prepaid insurance is a portion good for 35 months. Kay isa lang ka month ang expired. That's for the month of March. Next, we go to 14 dash question number 2. 14-17. Okay, 14-17. Prepaid insurance on March 31 is good for 35 months. Kaya ang expired 1 month pa lang. That's for the month of March. So meaning we have a remainder of 35 months. In question number 2, what amount should be reported as insurance expense for the 3 months ended March 31, 2020? Insurance expense per books of 72,000. Prepaid insurance before adjustment 3,000. The total is 75,000. Prepaid insurance on March 31 of 70,000. The insurance expense is 5,000. That's in question 14-17. 14-18, what amount should be reported as prepaid expenses? So we have now prepaid insurance, 72,000 times 6 over 12. Then prepaid taxes for 9 over 12. The total of the prepaid expenses on December 31, 2020 is 54,000. Okay, that's number 18. Alright, 19. 19 is the question is what amount of interest expense should be reported in the income statement for the current year. So we have now the interest paid. We add prepaid beginning and interest payable in. Again, remember that one is prepaid, the other one is accrued. Then deduct prepaid end and accrued beginning. So we have the interest expense for 114,000. In 14 dash 20, the amount of advertising expense for the year ended December 31, 2020. The balance per books of 990,000. Then we add accrued advertising expense 50,000 and deduct a prepaid advertising for 60. You now get the advertising expense for number 20 of 980,000. Then number 21, the total compensation expense for 2020, the balance per book, and then we add accrued salaries and bonus. Total of 683,000. Next, number 22, the balance per books, 820,000. Accrued legal expenses for November and December of 130,000. The total of the professional fee expense of 950,000. Next, in 14-23, under accrual basis, what amount should be reported as royalty expense for 2020 in number 23. So we begin now with royalties paid, a prepaid beginning, and we have now your prepaid beginning add prepaid ending deduct. Then, royalties payable, accrued din siya. So, we add the ending and deduct the beginning. Again, take note that the treatment of prepaid and accrued are in reverse. So, in other words, we have, if we add one, we deduct the other. Royalty expense in 2020 is 3,050,000. Next, in number 24, question is asking for accrued salaries payable January 1, 400,000. Salaries expense 4.2 million. Deduct salaries paid of 3.9 million. Accrued salaries end of 700,000. 14-25, what is the adjusting entry for supplies expense at year end? So the adjusting entry in 14-25, if you have now your supplies inventory on January 1 of 360,000, then payment for supplies debited to supplies inventory by 1 million and supplies inventory end of 600,000. So your entry will be to debit supplies expense by 760,000 and credit supplies inventory. Then 14 does 26. What's the amount of the adjusting entry for accrued wages payable at year end? So debit, okay, we have now wages payable beginning, then we add wages expense of 1.1 million. That's reported in the income statement. Wages expense of 1.1 million, then deduct wage payments of 950,000. We have wages payable of 250,000. That's for wages payable end. Then in 14 does 27, we have now the answer in 27. That's rental revenue for 2020. So we have now the cash received from tenants, 8 million, rentals receivable 2020, unearned rentals 2019, rent written off. So we have the total, then deduct receivable beginning and unearned ending rental revenue for 2020. Okay, and we have number 28 under accrual basis. What is the amount that should be reported as royalty revenue for the current year? So we have now the royalties received. We have the receivable end and the unearned beginning. Then we deduct the royalties receivable beginning and the unearned end. So we have the royalty revenue. So that ends our problems for chapter 14, cash and accrual basis of accounting. Now, I have already shared screen. Anyway, we have 14 dash 32. Okay, 14 dash 32. The multiple choice theory. 14 dash 32 and 14 dash 33. Okay, take note. 14 dash 32 and 33. Now we will proceed to chapter 15. Okay, on with the problems in chapter 15. In chapter 15, again, let's begin with the straight problems. So I'll start with 15-14 and 15-17, and then we go back to the multiple choice problems 1 to 13. Okay, so you refer to problem 15-14. So we will be able to analyze through the use of our single entry system. In other words, you do not maintain double entry. In double entry, you have debit and credit for every transaction. Now, in single entry, you do not involve a debit and a credit for every transaction, but you only list down the transactions. So, in 15-14, you are given now the single entry records for 2020 with the balances on December 31 and on January 1. Then you are given the cash receipts and the cash payments. Accounts receivable of 120,000 were written off as uncollectible. Returns of 320,000 were made on merchandise sales. Allowances of 80,000 were received on merchandise purchases. Required, compute the net income or loss using the single entry method and prepare an income statement. So for January 1 and December 31, for January 1, our total assets, we have from cash up to equipment. The total assets amounted to 6 million. So you just add cash, notes receivable, accounts receivable, merchandise, inventory, and equipment. So total assets of 6 million by January 1, and by December 31, 6,880,000. Total liabilities in January 1, 2,120,000. 2,120,000. Again, add notes payable, accounts payable, accrued interest payable, and unearned rent income. Now, this same with December 31. So, the capital on December 31 is 5,280,000. We add withdrawals during the year as given, withdrawals amounting to 400,000. Okay, withdrawals amounting to 400,000 given in your cash payments. The last item in you among your cash payments. So we have the total and then deduct capital in January 1 of 3,880,000 computed above, and we have the investment of 600,000 among the cash receipts. So the difference of 1,200,000, that's your net income. Notes receivable December 31 of 1.2 million. Then accounts receivable December 31 of 2 million. We have collection of accounts receivable of 3 million, and we have collection of notes receivable 960,000, sales discount of 120,000. We have the sales discounts given, sales discount 120,000, and we have bad debts 120. Sales discount 100,000. Ginhatag accounts receivable after sales discounts of 100,000. Then we have accounts written off given 120,000 and sales returns of 320,000. So the total 7.7 million. Then deduct notes receivable January 1 and accounts receivable January 1. The difference is sales on account. Then we have to deduct 5.7 million sales on account and add cash sales. 6.5 million is the total sales. So we are now computing for the net income during the period. We are given the amount of net income, and also to year net income of 1.2 million. Then we have to prepare an income statement. So net income 1.2 million, Then we have your total sales, 6.5 million. Oh, there. You have your notes payable and accounts payable and payment of accounts, payment of notes. Then we have the purchase allowance. Then total, we deduct notes payable January 1, accounts payable January 1. We have purchases on account. Then we add cash purchases. We have the total purchases. Then for rent received, add unearned rent income, then total, deduct unearned rent income December 31, we have the rent income. Sales price, less carrying amount of equipment sold, gain on sale of equipment. Then we have the equipment on January 1, add acquisition, total, we deduct equipment and the carrying amount of equipment sold. You now have your depreciation. Interest paid, add accrued interest payable, deduct, end is added, beginning is deducted. So you have interest expense. Finally, we have the income statement. For the year ended December 31, 2020, we will be using the amounts provided above. So net sales as found in note number 1, 6,080,000. Deduct cost of goods sold in note number 2. We have the gross income. Then note number 3, other income. Then we have the total income. Expenses, bad debts, depreciation, and interest expense. Now we have the net income figure. Following are the notes in arriving at the figures in the income statement. Okay, that's one problem, straight problem. Now we go to another straight problem, 15-17, with the prepare an income statement for the year ended December 31 and statement of financial position. Complex company kept very limited records. Purchases of merchandise were paid for by check, but most other items of cost were paid out of cash receipts. Weekly, the amount of cash in hand was deposited in a bank account. No record was kept of cash in the bank, nor was record kept of sales. Accounts receivable were recorded only by keeping a copy of the ticket, and this copy was given to the customer when he paid his account. On January 1, 2020, the entity started business and issued share capital 60,000 shares with 100 par for the following considerations: cash, a building with useful life of 15 years, land. An analysis of the bank statements showed total deposits, including the original cash investment, of 3.5 million. The balance in the bank statement on December 31, 2020 was 250,000. There were checks amounting to 50,000 dated December 2020 but not paid by the bank until January 2021. Cash in hand on December 31, 2020 was 125,000, including customer deposit of 75,000. During the year, the entity borrowed 500,000 from the bank and repaid 125,000 and 25,000 interest. Additional information: disbursements paid in cash during the year were utilities, salaries, supplies, taxes, and dividends. An inventory of merchandise taken on December 31, 2020 showed 755,000 of merchandise. Tickets for accounts receivable totaled 900,000, but 50,000 of that amount may prove uncollectible. Unpaid suppliers invoices for merchandise amounted to 350,000. Equipment with cash price of 400,000 was purchased in early January on a one-year installment basis. During the year, checks for the down payment and all maturing installments totaled 445,000. Equipment has useful life of 5 years. So we have now the income statement and the statement of financial position. First, we have to compute for the adjusted bank balance of 200,000. We deducted outstanding checks from the balance per bank. Then for the cash investment, proceeds of bank loan, collections of accounts receivable, that's the squeeze figure. We have the total deposits less disbursements in check, payment of loan, interest on loan, equipment, interest on equipment, payment of accounts payable, another squeeze figure. So we have the cash in bank on December 31. The collection of accounts receivable and payment of accounts payable are squeezed by working back from the cash in bank. So from the cash in bank, December 31, we have customers deposit, collection of accounts receivable of 600,000, total then disbursements in cash and cash on hand December 31 equal to 125,000. Now we have the amounts squeezed are payments of accounts payable and your collection of accounts receivable as they are squeezed from cash in bank. So you work backward, changing the signs if you work backward. And then we have your accounts receivable and collections deposited, collections not deposited, and we have the total sales. Accounts payable and payment of accounts payable, and we have the total purchases. So finally, the income statement, sales, given 4 million, cost of goods sold, purchase minus the inventory and we have now your cost of goods sold, leaving the gross profit. Then for expenses, you have utilities, salaries, supplies, taxes, doubtful accounts, depreciation of the building for 15 years, so that's 300,000, and for equipment for 5 years. In interest expense of 70,000, net income of 800,000. Here we have the statement of financial position. Cash, we have note number 1, conceivable note number 2, then we have inventory, non-current assets, land and building less accumulated depreciation and equipment, accumulated depreciation, and we have the total assets. Liabilities and equity, current liabilities, accounts payable, loans payable, and customers deposit. Equity, share capital, share premium, and retained earnings. That's note number 3. Total liabilities and equity. So we have now these notes to support the given figures. Okay, so we have, let's now go back to after problem 17. Let's go back to the multiple choice problems. We have the multiple choice problems in chapter 15. Here, question number 1. What was the net income for the current year? Net income for the current year. Again, we are still discussing single entry. Okay, for single entry accounting, we will involve the multiple choice problems 1 to 14. So question number 1 in the multiple choice, how much is the amount of net income? January 1, 2020, the statement of financial position showed total assets of 5 million, total liabilities of 2 million, and contributed capital of 2 million. During the current year, the entity issued share capital of 500,000 par value at premium of 300,000. Dividend of 250,000 was paid on December 31, 2020. Statement of financial position on December 31, 2020 showed total assets of 7.5 million and total liabilities of 3.2 million. So total assets, January 1 of 5 million, then total liabilities and contributed capital of 2 million, retained earnings January 1 of 1 million. Total assets December 31 of 7.5 million, then total liabilities 3.2 million and contributed capital of 2.8 million. That's the sum of 2 million plus 500,000 plus 300,000. Okay, so we have 2.8 million, total 6 million. Retained earnings is 1.5 million. Then we add dividends paid, 250,000. A total retained earnings, January 1 of 1 million. Net income of 750,000. So letter C. 15-2, during the current year, the entity declared and paid cash dividend of 1 million and also declared and issued a share dividend. There were no other changes in shares issued and outstanding during the year. What was the net income for the current year? So we have now share capital, beginning and ending, share premium, and retained earnings. So we have now increase in share capital of 5,750,000 minus 5 million. So the increase is 750,000. Increase in share premium of 500,000. So we have the share dividend of 1,250,000. Retained earnings and we have share dividend added, then we have the cash dividend, the total of 6,750,000. We deduct retained earnings beginning, we have net income of 3,250,000. Then in 15-3, actually we have only one requirement here. What's the retained earnings balance on January 1, 2020? So that becomes the last amount to be computed at the top. So we have to work backward. Retained earnings January 1 is unknown. Prior period adjustment, overstatement in 2019 inventory in the amount of 200,000, but we have to deduct back because if the inventory is overstated, in other words, the cost of goods sold was understated. So, ang inventory nga na overstated was the inventory on December 31, 2019. So that's the beginning inventory. That led the cost of goods sold overstated. So what happened? The net income was cost of goods sold was overstated. So net income, what happened? No, was also overstated. Ang imong beginning inventory overstated, you add to purchases, total goods available for sale is overstated. So corrected beginning balance, then add net income total, deduct dividends declared, retained earnings, and is 4 million minus 3 million. So the share capital of 3 million remained unchanged during the year, while at the beginning it was 4 million. So you have the difference of 1 million. That's the retained earnings at the end. So you work backward, changing the signs. 1 million plus 400,000 is 1.4 million. Add, deduct mo kay backward. So 700,000 and ang deduct na 200 will be added. So you get retained earnings on January 1 of squeeze figure 900,000. Then 15-4 was the retained earnings balance on January 1, 2020. Again, it's like 15-3. You are going to start with retained earnings balance on December 31. You have the total shareholders equity of 5 million, share capital deduct 3,300,000. So you get retained earnings and 1.7 million. 1.7 million add back 600,000 nga dividends declared, we get the total of 2.3 million and then deduct 900,000. The difference is retained earnings at the beginning of the period. Okay, so we have now 15-5. What's the net income for the current year? So we have now increase in assets, increase in liabilities. So we have the net increase of 6.2 million. Then we have the dividends to be added, total of 7.5 million. Then deduct increase in capital, net income of 900,000. Problem 6, net increase in net assets, and we have dividends paid, total, then deduct increase in share capital in share premium. You have the error to be corrected, so you have the net income of 2 million. In problem 7, we are now asked to determine the net income or loss for the period. So net income or loss. We have now increase in assets, increase in liabilities. So we have net increase in equity. Then we have share capital issued in excess of dividend. We have the net loss of 200,000. Next, in 15-8, what was the net income for the current year? Increase effect on equity. Increase in cash will increase equity. Increase in accounts receivable will increase equity. Increase in inventory, increase in equity. Decrease in investments will decrease equity. Decrease in accounts payable will increase equity. Increase in bonds payable will decrease equity. So the net increase in equity is 1,300,000. Then we have to add dividends declared in the amount of 300,000, total 1.6 million. We deduct increase in share capital 1 million and share premium 100,000. We have net income of 500,000. Next, number 9, what was the net income for the current year? The net income for the current year is 5.9 million. Effect on equity, again we have increase in cash, increase in accounts receivable and inventory, decrease in investments, increase in equipment, decrease in accounts payable, liability niya ha, increase in bonds payable, increase in accrued interest payable. So we have net increase in equity. We add dividends paid. We have now the total. Then deduct increase in share capital for 100,000 times 30 or 3 million. Increase in donated capital for 2 million. So we have the net income of 5.9 million. So the net income is 5.9 million. We have now 15-10. What's the net income or net loss for the current year? In 15-10, we have now a net loss of 140,000, identifying the effects on net assets. So cash increase, accounts receivable decrease, merchandise inventory increase, accounts payable increase, and here accounts payable is increased. Prepaid expenses increase, then accrued expenses increase, and earned rental income increase. So unearned rental income is a decrease. So the effect will be an increase on net assets. Accrued expenses increase. So the effect on equity will be a decrease. Prepaid expenses increase. So the effect on equity will be an increase. Accounts payable, actually accounts payable increase. So ang effect on equity is decrease. So net increase is 260,000. We add withdrawals, deduct additional investment. We have a net loss of 140,000. Then we go to 15-11. In 15-11, what amount of retained earnings was reported on January 1? So in 15-11, we have shareholders' equity 3 million divided by 150%. Liabilities divided by equity is 50%. So the shareholders' equity is 3 million divided by 150%. Kaya yung mga total assets nga 3 million. So we divide it by 150%. Shareholders' equity of 2 million, contributed capital 1.5 million, retained earnings 500,000. Share capital 1 million, share premium 500,000, contributed capital 1.5 million. Total liabilities 1 million, shareholders equity 2 million, that's 100%. Liabilities is 50%. Retained earnings on January 1, 1.3 million. Net loss 100,000. Dividends declared of 700,000. retained earnings on December 31 of 500,000. So that answers question number 11. What amount of retained earnings was reported on January 1? So it's 1.3 million by computing backward. Then we have problem number 12. Net income for the current year. We have now the effect on equity. If we have an increase in cash, here, cash increases or decreases. So, bali ang cash increase, accounts receivable, inventory, equipment, bonds payable ang nag-decrease, ang investments, kag ang accounts payable. During the year, the entity sold 100,000 shares with 20 par value for 30 per share and received cash in full. Dividend of 1.5 million was paid in cash during the year. Equipment with fair value of 2 million was donated by shareholder during the year. So net income for the period, we have now the effect on equity, increase in cash, increase in accounts receivable and inventory will increase equity, increase in equipment as well. Then we have decrease in investments will decrease equity, increase in accounts payable will increase equity. Accounts payable decrease, so equity will increase. Increase in bonds payable will decrease equity. So net increase in equity, 9.7 million. Dividends paid, 1.5 million. The total of 11.2 million. Then the increase in contributed capital and the increase in donated capital. So we have net income of 6.2 million. Now we have here the last multiple choice problem 13, but it has 3 requirements. So question number 1, what's the amount of purchases for the year? So the answer is B, 2,750,000. At the beginning of current year, Crispin Santos started a retail merchandise business. During the current year, the business paid trade creditors 2 million in cash and suffered a net loss of 350,000. The ledger pre-closing balances at year-end included the following. So accounts receivable, accounts payable, capital expenses, merchandise, unadjusted debit balance. There were no withdrawals. All sales and purchases were on credit. The merchandise account is debited for purchases and credited for sales. The amount of purchases for the year, we have now the payment to trade creditors of 2 million, and we have now the 750,000 nga accounts payable end. So purchases is letter B. The amount of sales for the period is equal to 2,050,000. That's the amount of sales for the period as based on the computations above. In question number 3, what's the cash balance at year end? So we have cash beginning, add collections, payment of accounts, payments of expenses, cash balance at the end. Letter A. And number 4, what's the merchandise inventory at year end? So we have sales. Then we have cost of goods sold. We have purchases, merchandise inventory end. So we have cost goods sold. We have the gross loss, expenses of 100,000. We have the net loss of 350,000. The ending merchandise inventory squeezed by working back from the net loss of 350,000. So the answer is B as in boy. Okay, so that ends our lecture for today. For tomorrow, I will be discussing chapter 16 about correction of errors. 17, we have already finished cash flow. So, hopefully by tomorrow, I will touch on chapter 18. That's the book value per share. 18, no? So, tomorrow, chapter 16 and 18. So, meaning we have only Thursday, Friday, and Monday left with chapters 19, 20, 21, 22, and 23. Okay? So, God bless everyone. Oh, nag-start ako, 11.